Vice Chair, do you want to start?
Lisa, can you hear me?
Now I can.
You know, there's probably several microphones on in here, so there's a lot of, let me try to turn off their microphone. Hold on.
So we're going to start housekeeping. The spaceship.
Good morning.
Good morning. What you can do is start the instructions. I'm going to call them to turn off these other microphones in this office.
Okay. It sounds like you're in a...
Thank you for participating in today's meeting. Please do not connect to Zoom or teleconference while in the room, and please silence all devices. Click on the globe at the bottom of your screen to select either English or Spanish. Public comment will be taken after each item. If you are in the auditorium and wish to comment, please use the iPads located in the lobby. For meetings in other locations, please complete a blue speaker card and provide it to a South Coast AQMD employee. Speakers may be limited to a total of 3 minutes or less for all agenda items, and times may be shortened to ensure all speakers can be heard. A countdown timer will be displayed on the screen for each public comment. More time will be allotted for Spanish translation that is not simultaneous. For questions or issues on public comment, please call the public advisor at 909-396-3247. That's 909-396-3247. Please adhere to the speaker time limit and treat others with courtesy, civility, and respect. Failure to do so can result in your mic being muted or you being removed from the meeting. Be aware that this meeting is being recorded. By participating, you are authorizing recording of audio and visual content presented during the live event and consent to subsequent use of the recording in the public domain by South Coast AQMD.
I'm not sure if the Vice Chair is back on. I don't know, Supervisor Hagman, do you want to?
Lisa, can you hear me?
Oh, there we go. We can hear you.
Okay. Call this meeting to
Good
order.
morning.
Good morning, everyone. I don't have the agenda in front of me. I'm trying to pull it up, but I will call the Investment Oversight Committee meeting, the hybrid version, to order. It's June 14th, 2024. And would you please call the roll?
Supervisor Hagman,
Hagman here.
Board Member Padilla-Campos,
Good morning here.
Mayor Salache is absent. Mr. Dixon,
Here.
Jill Wynot,
Here.
Chair Caccioti.
Here. Okay, let me see. I think I've got it. Here we go. Good. Sujata, our first item is quarterly report of investments. Go ahead, please.
Thank you, Chair. Good morning, Chair and members of the committee. Sujata Jain, Chief Financial Officer. This item is to report the cash balance in the LA County pool surplus and the special purpose investments. As of the end of first quarter, that ended on March 31st, 2024, the balance was $1,485,877,756.54. The composition of our investments are 90% in the LA County pool surplus and 10% in the special purpose investments. The earning rate for March 2024 was 4.11%. And on page 4 of the report, you can see the graph that shows a comparison of some of the counties and the 3-month and the 12-month treasuries. And AQMD's yield is pretty much in that range. So with that, I'll be happy to take any questions on this item.
Committee members, any questions?
No?
Sujata, is there any public comment?
There's no comments in the room and there's no comments on Zoom. There's no hands on Zoom.
Anybody at the other locations, any public comment? In Burbank, Pacoima, and another location here? Nobody here but me?
None.
None?
It
None,
was a
okay.
good report again, as I have said before.
Sujata, I just have I noticed on, and I don't have it in front of me because I'm still trying to pull it up. But I remember reading it last night on June 20th. I believe you have another, is it 10 or 20 or 30 million coming, maturing in a US Treasury note?
Correct.
What are your thoughts on that? A reinvest in a Treasury note? Because I noticed in your report on the 12-month Treasury or whatever it was pretty high, like 4% or 5%.
Yes, so Chair, I will reach out to the divisions to make sure that they still want to reinvest it. And then accordingly, I'll reach out to LA County and, see if a 6-month is higher or the 1 year. And accordingly, we will reinvest that.
Okay. Just a comment. I was looking at the, last night I reviewed all this. I was looking at the different investment returns. We're at 4.11 right now. In March, we're at 4.13. In 2023, we're between 3.09 and 3.78. And guess what? Just 2 years ago, in like May, June of 2022, keep this in mind, just 2 years ago, right now we're at 4.11. Anybody have an idea where we were on return on investment?
Yeah,
Take a guess?
probably in the 1 or 2 range
It was actually 0.69.
there.
0.69 2 years ago. Just put that in perspective. Look where we are right now, 4.11. Good job, Sujata and PBF. Go ahead.
Thank you, Chair. Should I move to the next item?
Yes, since there's no public comment, item number 2, cash flow forecast. Go ahead.
Yes. Thank you, Chair. So this item is a projection of our cash flows for the next 6 months. We're required to do a cash flow every 6 months. The next will be at our December 2024 meeting. Our lowest cash will be about $600 million in April of 2027. We can invest about 75% of this balance in special purpose investments, which is approximately $450 million. We have invested about $160 million in the special purpose investments. And with that, I'll be happy to take any questions on this item.
Committee members, any questions?
None?
And no hands here on Zoom, so no public comments.
Other locations, any public
None?
comments? None here in downtown Los Angeles too. We'll move on to the financial market update. Thank you, Sujata.
Thank you, Chair. Richard Babb.
Yes. Can you hear me?
Yes.
Yes.
Sounds good. Good morning, Chair and members of the committee. Could we go back to slide number 2? Perfect. Thank you. Just to give you sort of the key takeaways is that generally the economic picture is favorable. In fact, that's sort of the story that the Federal Reserve iterated in their meeting this week. Inflation's moderating, economic growth remains above long-term trends. Rates are expected to come down, but they're shifting the focus more to next year. The thing I would say is while the big picture is favorable, and it's not something I talk about in my thing, but things to watch is that we are seeing weaknesses on the edge of the economies. If you're a lower income individual, you've been more stressed on inflation. Higher rates have stressed certain parts of the economy. The other thing is there could be geopolitical events continuing on. Again, not directly covered in my presentation, but these are the outliers, whether it's war in the Middle East, war in the Ukraine, or a coming election. So to get in my presentation on this slide, what we show is the CPI through April. And what we got is the May numbers came out and they were actually a little more favorable. On the overall headline number, CPI was down only slightly at 3.3%. The core number was down to 3.4%. What people were liking is that the month over month numbers were down. So the headline number was down was flat month over month. A lot of that was driven by energy prices actually coming down over the month. But even core numbers, which exclude food and energy, were down only to 0.2%, which is basically at that 2% annual level. On this slide, what we're showing you is that the same story. We're seeing inflation moderated. The thing that I want to highlight on the left chart, this is showing you the cumulative inflation on each of these different components. And what we see is a lot of them remain over 20% cumulative growth from December of 2019. So inflation remains a story, even though we're moderating somewhat. If we go to the next slide, this is showing PCE inflation. So on this chart, I'm showing you the month over month changes. And this is the Fed's preferred measure. And what we saw is that if you look at that last two bars, that you saw the core number decline to still above 0.2% is where we need to, it was at 0.2%, we need 0.17 to come in at 2% for a year annualized. The headline, the core number was still elevated at 0.3. What's interesting is for the year, the Fed expects that the headline number to come in at 2.6 and the core number to 2.8. So they see inflation remaining elevated. Some of that is that they do it on a rolling 12 months. So what we're going to see is some of the higher numbers we had in, May of last year will be dropping off, and we'll get into some lower numbers. But so again, they're not seeing their inflation getting to where it wants to be, even though it's moderating. And again, even though the inflation numbers most recently have been favorable, they want to have greater confidence before they really cut interest rates. If we go to the next slide, this is producer prices, and it tends to be more volatile. Again, the overall story is inflation came down significantly from 2022 levels. Again, inflation in this area was more elevated because of supply constraints. We're tending to move more sideways. And again, there's certain aspects that are going up, going down. You see that food for exports, one of the reasons that it didn't go, but you see a lot of the other elements remaining above 2%, the Fed target. So inflation moderating, but still elevated. If we go to the next slide, from an economic standpoint, the job market's generally been favorable. And the next several slides will cover that. The chart on the left is what we're showing you is the unemployment rate. So we show it is the orangest color is the Riverside, San Bernardino, MSA area. The blue line is the California, and the gray line is the United States. The latest number for the United States came out at 4%. And that's basically what the Fed's expecting it be for the year. So again, it remains a very low level, but they are seeing some, what they call it about is the labor market coming in more in balance, which is what they are trying to achieve, but not a significant increase in unemployment. In fact, they expect it to end this year at 4%, and they expect it to end next year at 4.1%. On the chart on the right, what we're showing you is the labor force participation rate has been up somewhat. Again, more people entering the workforce, and it's above actually what the CBO was suggesting we would see based on economic trends. So again, that's generally favorable. If we go to the next slide, slide 7. Sounds good. Thank you. The chart on the left, what we're showing you is from the JOLTS report. And what we see is that the blue is the jobs opening, the red is the unemployed number. What the Fed likes is that this is coming into more balance. What they typically like to see it is about 1 to 1.1 jobs available to the number of unemployed. So in the latest report, we have 1.25 jobs available for every unemployed person. Again, doesn't mean that the jobs available match the people that are unemployed, but in general, that you're seeing that. We're definitely down significantly from, if you look at April of 2022, we had 2 jobs available for each unemployed person. The chart on the right is the monthly non-farm payrolls, the number of people added. And what we saw is in this report, it went up to 272,000 versus only 175. But what's interesting is even though it was lower in the past month, generally job growth has been very favorable to keep up with demographic growth, which is expected to be about 125 to 150,000 jobs per month. So again, generally a favorable economic condition. for supporting the economy and consumers being able to spend. If we go to the next slide, what we're showing you is that the blue is the wage growth, the red is the inflation number, and the shaded area between indicates whether there's an excess of wages versus inflation, or there's a deficit versus wages versus inflation. So we're definitely back into the period where wage growth is exceeding inflation on a current basis, which is what we would anticipate to see. The gap is somewhat narrowing somewhat slightly, what the Fed would actually see as being a favorable number in the sense that there's not as much upward pressures, but we are seeing it return to a more natural balance in that. If we go to the next slide, what's interesting is while basic economic conditions are very favorable, it doesn't necessarily mean it's translating to what the consumer is saying. So this is the University of Michigan Sentiment Index. And what we saw is that in recent months, it's actually come down, and we've had one additional report since this came out, and it actually dropped another 4 points. So the consumer is somewhat worried about that. And if you go to the chart on the right, is even though inflation is starting to come into control, that consumers are still worried about inflation going up a little bit. And it was a little higher in the latest report also. If I go to the next slide, one of the aspects that we see is that, especially on the edges of the economy, that we are seeing some weaknesses. So the chart on the right is the personal savings. The chart on the right is actually delinquencies. I apologize, wrong title. So what we see is that if you look from where we were in like January of 2022, delinquencies have come up very significantly. And this is what we're talking about is credit cards, auto loans, those types of things. But what you see is we're basically at the 20-year average. So again, a worrisome trend, but not necessarily a big threat to the overall economy. But one thing we are seeing on the chart on the right is one of the, again, elements of the weaknesses, that we're seeing people having spent down their savings or excess funds that they had in the pandemic when there were a lot of stimulus payments and everything else like that, which suggests that the consumer could be reaching their ends of where they're able to support the economy. And in fact, if we go to the next slide, retail sales on a monthly basis were actually flat in April. So again, generally, the economy is growing favorable. It's supporting growth, but there are concerns that the consumer may not have as much to spend. Gasoline stations, that was one of the big areas up, and that you see non-store non-store retailers, which is mainly Amazon, was down. Some of that's due to timing of when they have their sales and everything else. So again, generally, economic growth's good, consumer spending money, but we are seeing some flatness, but this can be volatile on a month-to-month basis. One other area, if we go to the next slide, that we are seeing continued weaknesses is in the housing market. So if you look at all these different elements, the key sort of story is that we haven't seen a recovery in the residential real estate area. That you look at existing home sales, they remain down versus where we saw in 2022. Building permits are down in the recent months. Housing starts up in the recent report, but again, not in a convincing way. A lot of it that's driven by the upper left-hand corner, where you see mortgage rates on an overall basis remaining elevated. With the Fed maybe moving towards cutting rates, this could help, but at least this is one area the market remains constrained. If we go to the next slide, what we show is the business aspect of the economy. So again, generally some moving in the favorable directions, but not a robust movement. The optimism index up in recent months, but again, you look compared to prior years, still somewhat constrained. Inflation, while down as a worrying in recent months, still remains an elevated concern to the business market. And again, you know, where they anticipate to raise wages and raise prices, you still see those coming down to more of a balance. So I think that's generally favorable, but again, not an overall robust economy. I mean, the economy is favorable, but again, it's not gangbusters. And if we go to the next slide, this is the ISM indices. So anything above 50 indicates expansion in that element of the market, and anything below that indicates contraction. So what we see is manufacturing got above 50, but now it's below 50. So again, not significantly. What was worrisome somewhat in the last report, and we get a different reading if we look at one of the other indexes, is that we actually saw some contraction in the service area of the economy. So again, what we're seeing is continued growth, but not necessarily gangbusters. If we go to the next chart, what this is, go to chart 15, thank you. What we're showing you is GDP on a quarter by quarter basis, on an annualized basis. And then the different colors indicate the different components of what the economy is driven from. In the last report, what we saw is this chart shows that 1.6 which is the advanced number. It actually came in at 1.3% in the next revision. But what we're seeing is a lot of it was driven by net exports, meaning we imported more than we exported. We also saw private inventories contract somewhat, which can be a volatile number. Consumers contracted a little bit on their spending, meaning it wasn't growing as strong in that blue element, but it's still a favorable number. What's interesting is that the Atlanta Fed's running estimate of second quarter GDP is coming in at 3.1% in the latest number. But what's interesting is they're seeing a lot of volatility and noise in the data because their forecast has gone from up to 4.2% at the beginning of the quarter to in the middle of this quarter that was as low as 1.8. The markets, the Federal Reserve anticipates for the entire year of 2024, not any one quarter, is that we'll grow at about 2.1%. So again, that's a favorable growth range. Actually, their expectations of sort of demographic growth driven GDP would be at about 1.8%. So overall, they still think we're above trend line. On the next slide, what was interesting is when this chart was done on 5/29, that we still saw interest rates high of their 1-year range, that shaded area. It had come down a little bit from April, but still remained elevated. Given what the CPI report showed at the beginning of this week and the FOMC meeting, we've actually seen interest rates come down. So the 3-month rate, which is at 4.38 on this chart, is still at 4.38 when I looked at today, because it doesn't tend to react until the Fed actually cuts interest rates. But longer term rates would start reflecting what the expectations of what the Fed will do. The 2-year, which was at 4.80 on this chart and actually been close to 5% in the recent quarter, is actually only at about 4.69% where I looked at today. The 10-year, 4.62 on this chart, is down at 4.20, and the 30-year, 4.74 on this chart, down to 4.34. So I think that also puts in good context to what the interest rate is that the district is getting on its investments. Again, over a 4% number. So it's sort of approaching where market rates are now after some of that lag. And if we go to the next chart, what the blue line is the 3-month. The 3-month reacts very directly to what the Fed's actually doing, not so much expectations. And as I indicated, it's basically at that 5.3 number. We expect it to come down as the Fed actually starts cutting interest rates. Only one cut sort of expected right now. The chart, the greenish line, orangish line, that again, my partially colorblind, is that you see a lot of volatility, but if I continued it today, it would only be 4.69. So we still sort of in the recent range, but at the lower end of it, given changing expectations. And that concludes my presentation, unless there are any questions.
Committee members, any questions for Richard?
Yeah, Mr. Chair, just real briefly, this is Supervisor Hagman. Hey, Richard, just again, crystal ballish. I'm hearing that the feds are still trying to push out between now and the end of the year a tremendous amount of stimulus money that they passed the stimulus package, the bipartisan infrastructure bill. I saw in the last one of the charts that government spending is down, but I'm hearing that it could be as much as $1 trillion they're trying to push out between now and November. They should announce next month. Does that change your predictions at all with inflation again or anything? with the government spending going back up?
It's something that's worrisome to me, potentially. Also, there in the additional information, there's a chart of the deficit that we're seeing that the deficit is continuing to increase in the amount of debt we have outstanding. The question, sort of in my view, it doesn't fundamentally change my view of what we think the economy is going to do in the next 6 months. What I'm more concerned with that type of number in the cumulative deficit is that creates bigger concerns for the longer term, 1 year in out. So that would be sort of my view, is that it doesn't fundamentally change what we see happening in the near term. It does have a big worry to me on the longer term, intermediate to longer term. Hopefully that was responsive to your question.
Absolutely. I don't know what we do. I just try and get tidbits from my investment person here. Thank you.
Exactly. And that's the thing that sometimes when we talk about this is we tend to be focused on the near term because that's affecting what the current interest rate environment is. It doesn't in our presentation really address what some very significant and big concerns are we're facing as a nation, just simply as a fiscal aspect of it, that government spending and the amount of debt we have outstanding will crowd out almost every other element of the federal budget. So, in which will have roll-on effects to local governments. So, again, a very good question. Thank you.
Thanks, Supervisor. I'm going to follow up on that. But Veronica, any questions?
Yeah, just curious on employment. I think you normally tell us sort of where those job growths are happening. Did I miss a slide, or do you have that information?
I didn't include that one in it. Let me see if I have it.
And then
I think I omitted it from this one. Services and government traditionally have been it, but I can't speak to that. I don't have the information in front of me.
okay, no worries. And you know, I don't know if I'm gonna ask this question correctly, but Social Security and its future, is it still a concern? Are we sort of balancing out in any way, or
It's definitely a long-term concern in a sense. I don't know what the current estimate of is when it runs out of money. Given the amount of government spending, given the amount of cumulative deficit, that could be at risk. Now, the question is, the government could still continue to make payments, that if the political will is not to do anything else other than continue Social Security, it will continue to do it. But I think we will be constrained from a fiscal aspect that it will be impacted by just the amount of interest payments that we're making, the cumulative debt in that. So again, near term, I don't see it being a problem. I think long term, it is a very concern. And the other aspect of it is that the political will isn't there to address it in one way or another. So,
got it. Thank you. No more questions.
Thanks, board member. Richard Dixon, any questions?
No.
Just following up on the supervisors and Veronica, we had this discussion at our council meeting recently. Richard, I'm looking at your slide at 27, the total public debt outstanding for the federal government. You've kind of touched on this a bit.
yeah.
It's about, I think it's $34 trillion now. I read it in an article.
Yep.
So I also read, and you talked about this, it's going to impact us at the local level, counties, even the states and the local cities. I read that every minute there's $2 million we're spending on interest. When you do that every month, it's about 90 billion a month. And it comes out to each year, just the interest on that debt is $1 trillion.
Exactly. And we're not making that money back. Sorry to interrupt you, Chair.
Go on, please. Yeah, that was disturbing to me. We had a big discussion at the council meeting, and we're talking about how the federal government will really impact us. When you're talking, like you said, they've got to just spend $1 trillion just on interest on the debt before they even spend a penny on anything else. How's that? What's your thought on that, Richard?
It's very worrisome to me in the sense that interest, part of the problem also is the amount of spending we've had. The other aspect of it is you alluded it to what the South Coast AQMD is earning in terms of interest rates. That's the same aspect in reverse that's happening to the federal government, that a lot of the debt that was issued when interest rates were very low, even if we didn't have an increase in debt, which is not what's going to happen, the amount of debt we're refinancing is going up at interest rates. So that $1 trillion will actually be a low number. The problem will become two effects. One, it will crowd out other spending. You'll have to increase taxes if you want to keep up with that. Or you'll have to devalue, or going back to another question we had, is that you'll have to devalue in a sense and create additional inflation going forward so you can pay back with cheaper dollars. So does it worry me over the next year or two? No. Does it worry me over the 5 to 10 plus year range? It worries me a lot, especially since, again, from a political aspect, we don't see the political will in Washington to sort of address it, on both parties. So,
it's, thank you for saying that. And it's worrisome to me, probably to Supervisor Hagman and AQMD. I mean, if they're spending $1 trillion just on interest, that means that trillion could have come to AQMD and, DERA grants, federal grants to local cities, and affordability for housing, for transportation. It's really concerning, but yet who wants to, pressure their federal officials who bring us the money? So I'm not sure. Any other comment, committee members, on this? Okay, is there any public comment there at the auditorium? Susan?
No public comment here, and I don't see any hands up on Zoom.
Okay, no public comment here. Veronica, anybody there at your place?
None.
None.
Richard, none? Okay.
None.
Thank you. And we'll move on to item 4, other business. Committee members, any other business you want to bring up?
Not for me.
Supervisor Veronica?
None for me. Thank you.
You don't see Kurt raising his hand. I have nothing. We'll move on to item 5, public comment. There's no public comment here. Any public comment, Susan?
No public comment here or on Zoom.
Veronica? Richard?
None here.
And no public comment here. Then I guess that our final item is our next meeting date, Friday, September 13th. Still good for everyone?
That looks good to me.
I heard there was a rumor about changing it to a different time. I like this time. Just want to make sure that's not being considered.
I don't know. Sujata?
Chair, we don't have any problem with this time.
Okay, good.
8 a.m. Friday, September 13th. Okay. Sujata, is there anything else we've missed?
No, Chair, that was it.
Okay. Sujata, staff, Susan, everyone, thank you so much. Supervisor, Richard, Veronica, all of you, and Richard, I will see you soon. Everybody have a great Friday, and I'll be here downtown waiting for the next meeting. Thank you.
Thank you.
Enjoy
Bye.
everybody's summer.
Yeah, you too. Bye-bye.
Thank you.